Good day, guys. Welcome to Forex Walker. Welcome to episode 61. On the previous episode, we were talking about the volatility index, VIX. So, on the volatility index, we expected the spike from the volatility index to manipulate this level. As you can see from this blue drawing, let me zoom it and show it to you. This blue drawing, it actually went all the way above it, but the expectation was based on manipulation, market manipulation. So we did get the market manipulation, and the good news on this market manipulation is that the Chinese government agreed to agreed to the U.S. The U.S. proposed talks on the tariffs, and the Chinese government agreed to those talks. We don't know where, when, and where the talks will be held, but the American president always thinks that everybody else has to visit him instead of him going to visit other people. That's probably why the United States is so setback, because if that president goes to China, he will understand how to build a country. So that is the first reason why we had this spike. The second spike, the second reason is the Tomahawk missile talks on Friday, yesterday. So what happened? That was the 17th. Today is the 18th, the day that I'm recording this video. So President Zelensky, the president of uh, Ukraine was headed for the United States for talks on. He wanted to ask for Tomahawk missiles, and the president decided to refuse to give him those Tomahawk missiles. And the reason why we had this spike was because the president of Russia would have retaliated against it, but I believe that he used a blackmail system, which was his intentions of planting nuclear bombs in Cuba next to the United States. So what would happen is that the blackmail will be in this way. The president of Russia would say, uh, "I don't mind if you want to give Zelensky those Tomahawk missiles, but you need to know that I'm also going to plant nuclear weapons at your border." So that's the blackmail that I believe would have been made by the Russian president, and I think it deterred the US president from offering those weapons. So we did get a manipulation here, and the volatility index had since reversed. As you can see, we had the retrace. But if we get another change in talks, we might get a move higher. But at the moment, I'm expecting this to be the end of, as you can see, I've drafted a price action projection. I'm expecting this to be the end of the spike, and that brings me to the current trade that I'm holding. So here we have the CAD JPY, and the reason why I'm willing to buy the CAD JPY is because of these two people here. Let me show you. This is the volatility index, and the volatility index is directly proportional to the Canadian dollar. Uh, this is WTI crude oil is directly proportional to the Canadian dollar because Canada is mining crude oil, but you need to understand that the oil in Canada contributes only 10% of the GDP. So don't expect the volatility index, don't expect to see a spike on the volatility index and see the same spike on the Canadian dollar. So what I'm looking at here, sometimes the spike in the Canadian dollar is delayed because of the 10% correlation, but eventually it goes. So here what I'm looking at is that we have our first touch, second touch, and the third touch we expected to manipulate. That's the reason why I believe that the oil market will take off from this manipulation on the third touch, and hence the same, and that will contribute to the Canadian dollar from giving us that pump higher. So on the previous episode, I talked about this is CAD JPY, so that we do have a disadvantage in trading JPY crosses or JPY currency pairs because they are directly proportional to the volatility index. And the reason being, when you get a spike on the volatility index, what will happen is that this currency will collapse all the way down here, and the trade that I'm willing to hold here will fail if that volatility index decides to continue to move higher. So those are the advantages and the disadvantages that you get from trading JPY trades. But if the volatility index decides to continue to drop lower, what will happen is that this trade with the CAD JPY will be boosted. So at the moment, on the previous episode, I talked about the market gap between these two candles, and that forming what we call a flip zone. So in this flip zone, I told you that normally when you have a market gap like this, not this one is a flip zone market gap. When you have a market gap like this, normally the market reverses halfway in the middle of the market gap. It does not necessarily have to reverse to this purple line that I've drawn on the previous shoulder. Remember how I trade? On the previous shoulder, we normally expect the market to turn around on the previous shoulder and even go as far as manipulating it. The manipulation being the landing on this candle here, on the body of the candle or at the top of it. So when you see this, normally the market reverses this way, uh, but when you have a market gap, the market does not necessarily have to go all the way down there. It has to, you need to look for a flip zone that is being formed on this tiny market gap. And the market normally reverses, it normally lands on that flip zone and takes off. As you can see, those bodies of those candles are not at the same level. Let me show you an example of candle bodies that are at the same level. You can see here that this candle closed here and it opened here and it went higher and then it went down. So these bodies of the candles are at the same level, but these ones, this one is higher compared to this one. So that is a market gap. It forms a flip zone. So the market landed here halfway of this market gap and it reversed, which is the normal expectation that I have. So that's how I'm willing to trade the CAD, but this trade is risky in case the volatility index continues to do what the volatility index does. I'm trying to push this guy forward so that if the volatility index decides that this is a tiny pullback and I will continue higher, even after the agreements, even after the refusal of the U.S. president refusing to offer those Tomahawk missiles. If it reverses, all JPY currency pairs will fail because this market will drop all the way down here. So that is the disadvantage. The advantage is that this might be the end of the trade. So I'm expecting the oil market to move higher and the CAD to continue. So the best way for you to take those trades. I'm trying to move backwards, but this guy's not moving backwards. So the best way for you to hold that trade is by looking for both high risk currencies in the euro Canadian dollar. If you can get both currencies that are high risk currencies, they are oppositely correlated to the volatility index and the JPY at high risk situations. So at the moment, I'm expecting the euro CAD to drop lower. This is just a manipulation. Let's look. Let's check for where the manipulation came from. Let me go for the weekly time frame and see if I can get that third touch. So here we had a we may not count these two. So we have our first touch, second touch, and the third touch normally we are expected to manipulate. And because we are buying the CAD will be bought to the south side. That's where we are expecting to buy the CAD. And the euro, we're expecting the euro to continue to. The euro gave us a spike, a tiny spike, because most people believe that the euro is also a safe haven, but it destroyed that trade that I have on the euro Turkish lira. So I had to liquidate that trade. You never win everything. Sometimes you win some, sometimes you lose some. But in trading, we are investors. We don't win because we don't gamble. So I'll be holding both these trades. If the volatility index decides to continue to move higher, which I don't believe will happen because the tensions were removed when the president of the U.S. Decided not to offer those Tomahawk missiles, and the Chinese government agreeing to meet for tariff talks on when the U.S. president decided to use sanctions against China, and those sanctions ended up backfiring against the U.S. president. So you guys wanted to see how I set up my trades. This is how I set up my trades. This is the shoulder where I'm expecting uh, the market to reverse, and this is, let me see. I don't know where this guy will begin, but I'm expecting the market to break below this low because this is a whack-off schematic, and an expansion is when the market or when volume comes into the market, or just an expansion is when the market breaks the previous shoulder. It breaks higher above the previous shoulder and it breaks below the previous low. That's what we I call volume coming into the market. Or so I'm expecting something like this to happen, and that's how I will hold this trade. And we'll see what happens to this trade. I'll be watching it, and I will be taking a short on this trade, and also on the CAD JPY. I wanted to show you the Turkish lira trade. Let me just. So this is where we ended with the Euro Turkish lira. I believe that this trade will continue lower, but I had to liquidate the trade because I don't like it when it reverses. Thank you guys. See you on the next episode.